What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be talking about in this update video is something very interesting that I have just found on some key pieces of the Ortex data that we have been looking at for the entire time that we have been following this AMC and GME saga. We also have to do a comparison of what the options chain was looking at before the last run-up and what we are looking at in terms of the different gamma ramps that we have leading up into this big January expiration date for this potential next run up. We're going to go over the max pain, and we have two more very interesting things to talk about in terms of margin calls. Now, these two things are not necessarily directly related to AMC, but the things that we are going to talk about in the earlier part of this video are very, very correlated to the price action that we have seen in the past. And I do believe that this is going to correlate to the next potential big price run up that we are all expecting to happen in the near future. So before we get into all of that information, if you enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So the one thing that we have been talking about a lot on this channel over the last couple of weeks is what I like to call the danger zone. So previously, we were seeing the danger zone in the low to mid 50s. Then after the next significant sell-off, in my mind, with what we were looking at in terms of the average days on loan, I was speculating that the danger zone could be mid 40s to low 40s. But there's a couple of reasons why I was looking at this. So when we take a look at this chart right here, we can see that on June 7th, the average days on loan went from 55 days all the way down over the next half of June to about 34 days, meaning that a lot of shorts were piling into their positions. Now, what was this first date right here? June 7th. When we come over to the chart and see exactly what date June 7th was, well, it was right around here. And what did we see right after that? Another significant sell-off. Yes, we did start to bounce back up, but then we overall started to come on that downtrend. Now, when was the last time that we saw one of these giant dips in the average days on loan? Well, it was right around November 15th. When we come back to November 15th, that was around the time that we started to see the new variant scares, the debt ceiling scares, all of this fear mongering that was happening in the market, and we started to trade lower. Now, here's kind of where this little speculation or theory really comes to a head in my mind, and why these danger zone levels in my mind are so important. When I think about what we need to see in order to get up to that really next big price run up, well, we need to cross a couple of different threshold barriers to really set off the gamma, the FOMO, the small amount of shorts covering, and apes buying even more shares. Now, when we come back to see really the first time that we saw the average days on loan significantly decrease, it was March 15th right here. When we come over to Weeble's chart right here and we see what date March 15th actually was, we are seeing that it was trading right around $14.50. If you guys remember, I think Matt was calling out $14.50 as a pretty important technical level in order to start this big June run-up. $14.50 was the previous danger zone that we were seeing before the big June run-up. So right now, with what we were seeing on that danger zone, again, let's go back to these dates right here, November 22nd through the 15th. The danger zone in my mind is right around these levels of the low 40s. Now, here's where this gets a little bit interesting and why we can kind of basically speculate that this situation that we have setting up for AMC is slightly different than any of the options expirations that we've seen in the past. When we come over to Stonko Tracker right now, again, we are seeing those 110,000 contracts in the money at that January expiration date. And again, for those of you guys who are curious, the max pain going into this next week is $29 a share. So when we come back over to Webull over here and take a look at the options chain for January, we can see that there's already a 57,000 open interest at that $40 mark. So as we start to approach that danger zone, well, there's going to be even more buying volume coming in from a lot of these market makers who are selling a lot of these options. But again, to even get up to some of those levels, we are going to need to see a lot of that buying demand and that buying volume come back into the stock. Now, here's how this options chain is slightly different to what we've seen on the past with AMC in that big June run-up. When we come back to some of my previous videos and pulling up the options chain over here, yeah, we can see that after we saw that initial spike before we saw those 100% days, we had a lot of deep in the money contracts on AMC. Now, the thing about these deep in the money contracts is that they're very, very good to have. When you have contracts and open interest that is concentrated at very, very low strike prices, it's very easy for retail investors to exercise those contracts. Now, the thing that we also have to think about here is what is the market maker's net position on a lot of these contracts. I remember before the June run-up, I was holding one of these $40 strikes going into this January. I don't hold this anymore, but I remember I bought this contract for around $90. So we're seeing that these contracts right now are trading for about $55. Now, when we think about that, so it really means that the market makers are still kind of all right on a lot of the contracts that they are selling on this options chain. But as we start to see those price movements to the upside, their losses get bigger, and they have to hedge and keep hedging and buying shares. And we start that positive feedback loop that we need to see. The other thing is the gamma ramp. And when you think of a gamma ramp, it's essentially when you look at the open interest and see, well, where are the contracts concentrated and what are the different gaps between the strike prices where we see those types of concentrations in terms of open interest. So when we look at AMC, we can see that there's a decent amount all the way through. We can see 10,000 here at 30. We can see 6,000 at 33, 4,000 at 34, 12,000 at 35, and it really kind of slows down until we get to 40. And then we see those big jumps again. When we come back to the previous option chain from this same video before, well, we see the large amount of contracts at 30, nothing really until 35, and then that crazy amount at 40. I would like everybody to kind of think about the $40 strike for June in a similar way to the way a lot of people are thinking about the $145 strike for this January. Is it possible that those run in the money and we run through the chain? Absolutely. But this is not something that you should be putting your life savings into because, again, options are incredibly, incredibly risky. Now, all of these price movements to the upside and thinking about that danger zone is going to trigger some margin calls. Now, I have to say this in almost every single video where we talk about margin calls, but margin calls do not mean shorts covering MOAS. It really essentially means, hey, whoever has these positions, you need to add more liquidity and collateral to your account. If you cannot do so, then you have to start unwinding their positions. So we see margin calls go out every single day on a wide variety of stocks, but you don't see them go absolutely nuclear when these margin calls come out. It is a slow process, and what we are really looking for is forced liquidations. Margin calls just put more pressure on a lot of these institutions. Now, coming over and furthering this conversation on margin calls, we have this filing right here that actually came out December 16th, but the effective date and when this is going to become effective is tomorrow on Monday. So the Fixed Income Clearing Corporation's Government Securities Division will reset each netting member's individual total amount, the CCLF cap, on January 3rd, 2022, the first trading day of the year. The reset will reflect a look-back period of July 1st, 2021 to just December 31st, 2021. And again, this new cap will be effective on the first trading day of the year. As reflected in the officer certificate, each member has certified, among other things, that it will incorporate any change to its total individual total amount into its liquidity planning, and it will, through periodic discussions with its financing sources and other methods, continually reassess its liquidity plans and related operational plans and procedures, including in the event of any changes to the member's CCLF cap, meaning that on any of these different fixed income positions, meaning anything that has to do with the bond market or interest rate swaps or anything of that nature, well, the amount of scrutiny that is going into the collateral and the leverage requirements on these types of positions is going to increase, and again, put a lot of pressure on these institutions. And then going off of the derivatives conversation that we've been having a lot on this channel, when you think about these over-the-counter derivatives and these swap contracts, which a lot of these contracts are heavily concentrated in, as we can see here, the swaps have the most notional value across the board of any of the other types of derivatives or OTC derivatives that we look at. And typically, a lot of these contracts are going to have some sort of expiration date, and typically they're about a year, 2 years, whatever. It's usually about a yearly time frame where these contracts have their expiration date. So if you're buying these contracts in January of any year, well, the contract expiration is going to come up this January. So you're going to see potentially some volatility coming in the broad market, and maybe some of these banks, JP Morgan, Goldman Sachs, Citibank, Bank of America, have some issues going into the process of kind of unwinding or rolling over a lot of these trades. Remember, in quarter two, Goldman Sachs sold off 25% of its total equity positions, which is very, very strange to do. They cited debt ceiling, Evergrande, some other things that were happening. But again, when you think about what typically happens with those major market events, they're usually kind of nothing burgers, and the market just keeps kind of chugging in its overall direction. And we can see here that Goldman Sachs has a leverage ratio of about 133 to 1. And so, and these other banks that we have listed here also have pretty insane leverage ratios as well. So we are seeing a high amount of over leveraging. And we know that the shorts on AMC and GME are highly over leveraged as well. It is only a matter of time before we reach those danger zone levels and start to trend back up to the upside and potentially even break and make new all-time highs. So that is going to wrap up this update on AMC and the whole broad market situation that we have going into 2022. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I'll see you guys in the next video.